AI just put a price on silver, and it is higher than the number you see on your screen because the real price is not printed on a chart. It is printed inside the physical bottlenecks that keep the modern economy running. Last year, the world wanted roughly 1.1 to 1.2 billion ounces of silver, and the world supplied roughly 1 billion ounces, give or take. That gap sounds small until you translate it into the only language markets respect: percentage. When supply is about 1 billion ounces, a shortfall of 150 million ounces is about 15%. In most markets, a 15% shortfall is not a story. It is an emergency. And that is the part that should have been everywhere. Not because silver is shiny, but because silver is the quiet metal inside the loudest industries on Earth: solar panels, electrification, data centers, and the reliability hardware that keeps servers alive at 3 a.m. when nobody's watching. You do not notice silver when everything is working. You notice it when delivery times stretch, premiums appear, inventories shrink, and suddenly the cheapest input becomes the most expensive headache. You did something rational for years. You looked at silver and you said, it is small, it is boring, it does not move like crypto, it does not move like tech, it cannot matter that much. You saved attention, you saved time, you saved emotional energy. But you paid for that decision anyway, just not in the place you were looking. You paid it through higher power bills, you paid it through higher hardware costs, you paid it through a world that has to spend more money to keep electricity stable, clean, and always on. Because the new economy is not a website, it is an always-on factory that runs on electrons. If you stay with me until the end, you will get 3 things. You will get a clean map of where the silver actually goes with the numbers that matter, not the myths. You will get the signals that tell you when the system is tight for real, not just trending on social media. And you will get the company map: who benefits first, who benefits later, and who gets hurt by higher silver, even when silver is rising. Then you can decide what you want to do with your money without guessing. Before we go any further, do one small thing for yourself. Subscribe, because this is the kind of market that moves slowly for months, then violently in weeks. And the people who do best are the ones who already built the map. And share this with one friend who still thinks silver is only jewelry, because the next decade is going to teach a lot of people that conductivity is not a fashion statement. It is infrastructure. Now let us build the map from the ground up. Silver has 2 big sources: new supply from mines and recycled supply from scrap. In a typical year, mines contribute most of the flow, something like 800 million ounces, and scrap adds something like 200 million ounces. Round the numbers and you still see the shape. About 4/5 from the ground, about 1/5 from recycling. That mix matters because it tells you how fast the market can respond to higher prices. Mines do not respond fast. Mines respond on a multi-year timeline. Recycling responds faster, but it also depends on whether people have enough old material to recycle and whether the economics work at that moment. A tight market cannot instantly fix itself just because price moves on a screen. Now, where does the silver go? This is where the story changes, because most people still picture coins, bars, and necklaces. Those exist, but the demand engine that keeps getting stronger is industrial use. Industrial demand has been in the neighborhood of 600 to 700 million ounces per year recently. If total supply is around 1 billion ounces, that means industrial use alone can be around 60 to 70% of the market. That is not a side dish. That is the meal. Inside industrial demand, there is one segment that has become large enough to swing the whole market by itself. Solar silver demand has been roughly in the neighborhood of 150 to 200 million ounces a year. Put that next to the 1 billion ounce supply and you realize solar can represent something like 15 to 20% of the entire supply chain. That is huge. That is a demand category that can make the difference between a balanced year and a deficit year by itself. Now add the second leg of the stool: electronics and electrification hardware. Every time you move power more efficiently, every time you reduce heat, every time you need reliability, you use materials that perform. Silver is not used because it is pretty. It is used because it conducts electricity better than any other metal and resists corrosion in ways that keep connections stable. You can thrift it, you can use less per unit, but you cannot remove it from a lot of critical applications without paying for the decision somewhere else, usually in failure rates. And now we arrive at the part people think is just hype, artificial intelligence. The trick is that AI is not a software story first. AI is an electricity story first. The reason NVIDIA became the symbol is not because NVIDIA is a magician. It is because NVIDIA sells the picks for a gold rush that is measured in every rack of accelerators is an electric furnace that does math. When you scale AI, you scale electricity, cooling, backup systems, power, quality, and uptime. That is the physical world. That is copper and steel and transformers and switch. And inside that hardware stack, silver shows up like salt in food. You do not notice it until it is missing. Let us run the electricity numbers because they reveal the direction of gravity. Global electricity generation is on the order of 30,000 terawatt hours per year. Data centers in recent years have been on the order of a few hundred terawatt hours per year, roughly around 1 to 2% of global electricity. That sounds small until you remember what is happening. The total world is a giant ocean. Data centers are a fast-growing river entering that ocean. If the river doubles, it still looks like a river compared to the ocean, but it changes the shoreline wherever it hits. Utilities do not build for global averages. Utilities build for local stress. A 1% global number can translate into a 20% local capacity problem in the places where the build-out is concentrated. Now look at the growth path. If data center electricity use roughly doubles over the next several years, that is not just a headline. It is a compound growth rate. Doubling over about 6 years is roughly 12% growth per year compounded. 12% compounded is what turns a manageable plan into a panic when you are building substations, upgrading transmission, ordering transformers, and hiring skilled labor. This is why the real constraint is not only chips, it is the grid, and this is where the silver thesis gets sharper. When the world is already short something like 10 to 15% of annual silver flow in a deficit year, you do not need a big new demand shock to move price. You'll need a steady squeeze where industrial demand stays high and investment demand stops being negative. The market is not huge. If total supply is around 1 billion ounces, then 50 million ounces of additional net buying is 5% of total supply. 5% is not a mood swing. It is a structural shove. If the deficit is around 150 million ounces, then 50 million ounces is 1/3 of the deficit. That is the kind of math that makes a quiet market suddenly become loud. This is why people get confused. They stare at the price and they say it is not moving, so nothing is happening. But tight markets do not always show up first in spot. They show up first in the plumbing. Premiums over spot, delays, inventory, drawdowns, backwardation in pockets, and a strange thing where paper can look calm while physical feels stressed. Think of it like a grocery store. The price tag on the shelf can stay the same for weeks. Meanwhile, the warehouse in the back is getting emptier. The manager starts limiting how many cases they will sell to one customer. Then one day the delivery truck is late. 2 people buy more than usual, and the shelf is suddenly empty. The price did not cause the shortage. The shortage was already there. The price just shows up late, like a fire alarm that starts ringing after the smoke filled the room. Now, let us talk about the popular argument against this, because you should never buy a narrative without stress testing it. People say solar is using less silver per panel, so the problem goes away. That is partially true. Manufacturers have reduced silver intensity over time, but the market is not about intensity alone. It is about intensity multiplied by volume. If silver per watt falls by 10%, but installations rise by 30%, the net silver used rises anyway. 1.3 times 0.9 is 1.17. That is 17% growth in silver use, even though each unit got thriftier. This is how people lose money. They focus on one variable and ignore multiplication. People also say recycling will solve it. Recycling helps. But remember the share. Scrap supply is roughly around 1/5 of total supply in many years. To cover a deficit of 150 million ounces, scrap would have to increase dramatically. And that requires both material availability and economics. You do not conjure scrap out of thin air. You wait for products to reach end of life. You build collection systems, you process it, and you do it in a world where costs are rising. Scrap can respond, but it cannot instantly replace a structural gap. The third argument is that a recession kills industrial demand. That is the strongest counter case. It is real. If global manufacturing contracts, some silver demand falls. But here is the key distinction. Not all industrial demand is discretionary. Some of it is tied to policy and infrastructure cycles. Some of it is tied to energy transition. Some of it is tied to the need to expand and harden grids. And AI capex has shown a habit of continuing even when the economy slows, because the race is strategic, not just cyclical. That does not mean it is invincible. It means you need to watch the right numbers to know when the tide is turning. So let us build those numbers into a simple dashboard you can hold in your head. First, the annual balance. Supply around 1 billion ounces. Demand around 1.1 to 1.2 billion ounces in strong years. Deficits on the order of 100 million ounces in tight years. When you hear someone say, well, who cares about a few million ounces? You can answer with scale. 10 million ounces is 1% of supply. 20 million ounces is 2%. 50 million ounces is 5%. Those are not tiny in a market this size. Second, solar demand in the neighborhood of 150 to 200 million ounces. That is 15 to 20% of supply. That is why solar matters. Even small changes in installations or silver intensity can shift tens of millions of ounces. Third, industrial demand around 600 to 700 million ounces. That is 60 to 70% of supply. That is why silver is not just a monetary metal anymore. It is a hybrid, part industrial commodity, part financial asset. Fourth, data center, electricity, and grid buildout. A doubling path implies around 12% compounded growth in the electricity footprint of data centers. And that is what drags massive capex behind it. Capex is where the metal demand lives. You can delay it, but you cannot avoid it if you want reliability. Now let us connect this to stocks, because the viewer always asks the same question. Where does the money flow? There are 3 lanes, and each lane has different risk. The first lane is direct exposure to silver price, silver miners, and streamers. Names like Pan American, Silver, ECLA, Fierce Majestic, Fresnesia, and streaming names like Wheaton Precious Metals. The mechanism is simple. If silver rises 10% and costs rise 3%, margins expand. If silver rises 20% and costs rise 5%, margins expand more. The leverage is real, so is the risk. Mines have geology risk, jurisdiction risk, and cost inflation risk. When energy costs rise, when labor costs rise, when a project slips, the leverage cuts both ways. That is why people either do well or get hurt. They size wrong and they expect a straight line. The second lane is the electrification and reliability lane. This is the lane that benefits from the AI electricity build-out, even if silver price is choppy. Companies like Eaton AB, Schneider, Electric, Siemens, and data center infrastructure names like Vertiv. The mechanism is also simple. When utilities and hyperscalers raise capex, order books grow. When order books grow, revenues grow. When revenues grow faster than costs, margins hold. The risk here is valuation and cycles. If everyone already priced in perfection, a slowdown can still hit the stock even if the long-term trend is up. The third lane is the lane people misunderstand. Solar and electronics supply chains. Here, silver can be both a tailwind and a headwind. Solar growth can increase silver demand and support the metal price. While higher silver can raise input costs for some manufacturers, that means a world where silver rallies does not guarantee every solar stock rallies. It depends on pricing, power, supply chain contracts, and interest rates. You can be right about the metal and wrong about the equity if you pick the wrong mechanism. Now pause and feel the ledger beat again, because it is the core of this story. You saved mental energy thinking AI is virtual. You paid anyway through the physical build-out. You saved time ignoring silver because it is small. You paid anyway because the market is small enough that deficits actually matter. And right here is where the mystery deepens. Because there is one thing that decides whether silver drifts, grinds higher or snaps higher, and it has nothing to do with whether people on the internet are bullish. It is where the shortage shows up first. Most people think the first sign is the spot price spiking. That is the last sign. The first sign is quieter. It is the part of the market where promises meet metal, where inventories matter, where delivery matters, where the system either has slack or it does not. In the next stretch of this story, we are going to walk into that room, and when you see it, you will understand why a market that is only 1 billion ounces a year can still behave like a trapdoor. Because when a deficit is already 10 to 15%, the difference between calm and chaos can be as small as a single decision by a single class of buyers, and the signal appears first in places almost nobody watches. Those places are not glamorous. They are warehouse lists, delivery notices, inventory categories with boring names, and a small line item called the premium that quietly tells you whether metal is available or only promised. Start with the simplest piece of plumbing: the split between metal that exists and metal that can move. In the biggest vault systems, you will see large totals and then smaller totals that are actually deliverable. Think of it like a restaurant. The freezer may have a lot of food, but only a portion of it is prepped and ready to serve tonight. If a rush comes in, the menu does not care about the food you might prep tomorrow. The menu cares about what is ready now. In silver, that difference matters because the paper market can trade enormous volume every day, while the deliverable pool is far smaller. If you see daily trading volume that represents multiple times annual mine supply, you are watching a market that is mostly paper. That is not automatically bad. It is just a structure. But when physical gets tight, that structure becomes a leader. You save brain power by assuming a lever cannot move the real world. You told yourself paper is paper. Physical is physical. They are separate. And in calm periods, that feels true. But you paid for the assumption because the bridge between paper and physical is where the price is discovered. When the bridge is stable, everything looks normal. When the bridge strains, the smallest stress creates the biggest move. Here is the first number that matters. In a market that supplies around 1 billion ounces a year, even a deliverable pool of 50 million ounces is only about 5% of annual supply. If the deliverable pool is 100 million ounces, that is 10%. That means a single quarter of industrial demand, which can be something like 150 to 200 million ounces, can be larger than the deliverable pool that the market uses as the pressure valve. That is why physical tightness does not need an apocalypse. It only needs normal demand meeting a small deliverable cushion. Now, if you are thinking, fine, but investment demand is a sideshow, here is the uncomfortable arithmetic. Investment demand does not have to be huge to matter. If investors collectively swing from selling 50 million ounces worth of exposure to buying 50 million ounces worth of exposure, the net swing is 100 million ounces in a 1 billion ounce market. That is 10%. 10% is the difference between stable and unstable. 10% is the difference between a quiet range and a trend that feeds on itself. This is why the first place you watch is not the chart. It is the cost of immediately sourcing metal. In any commodity, when availability tightens, the first symptom is that people who need the commodity right now start paying extra. That extra shows up as premiums on coins and bars. Yes, but that is the retail layer. It also shows up as premiums in wholesale channels and in the way contracts get written. Let me make this concrete. Imagine you are a manufacturer that uses silver in contacts or solder or coatings. You are not buying a coin. You are buying a component supply chain. If silver is 25 on the screen and you can source what you need at 25 plus a small fabrication fee, you do not care. You treat silver as stable. But if silver is 25 on the screen and the real invoice comes in at 28, because availability is tight and lead times are stretched, then silver is not 25. For you, silver is 28. That is a 12% difference created without the spot price moving at all. You did that. You watched spot and you saved energy by ignoring everything else. But the ecosystem paid the higher invoice anyway. The invoice just did not show up where you were looking. Now, layer in the second piece of plumbing, the cost of borrowing metal. In tight physical markets, the cost to borrow the commodity can rise. This is not a theory. It is basic scarcity. If a manufacturer or a trader needs metal today and they can borrow it and return it later, the rate they pay reflects how scarce immediate delivery is. When the borrowing cost rises, it is the market whispering that the warehouse is not a deep lake. It is a shallow pool. Think about the logic. If metal is abundant, nobody charges much to lend it. If metal is scarce, the lender wants compensation, because lending reduces their own safety buffer. The rate becomes a fear gauge, but a physical fear gauge, not a social media one. Now the third piece, the shape of the forward curve. In call markets, the future price is typically a little higher than the spot price, because holding inventory costs money and there is an interest rate component. But when physical is scarce, the market can flip. The spot can trade above near-term forward prices. That sounds technical, but it is just a human story. It means people will pay more to have it now than later. It means the market is putting a premium on time. Time is the only resource you cannot mine. In a market like silver, where annual deficits have recently been on the order of roughly 10% in tight years, the curve matters because it tells you whether the market is paying you to hold metal or begging you to hand it over. Now let us connect this to the AI and NVIDIA angle so you can see why it is not hype. It is a spreadsheet. Start with NVIDIA. NVIDIA is a proxy for the scale of the build. When NVIDIA grows data center revenue fast, it is not just chips. It is racks, it is networking, it is power distribution, it is cooling, it is backup. It is the entire physical plant required to run those chips. If you see a quarter where the industry collectively adds tens of billions of dollars in capex guidance, you should not only hear growth, you should hear material demand. Here is the capex math in plain terms. If a hyperscaler spends $50 billion in a year on data center infrastructure, and even 10% of that is power and electrical hardware, that is $5 billion of electrical gear. If the sector collectively spends $200 billion and 10% is power, that is $20 billion. Now ask what happens when the world is constrained, not by money, but by delivery times. Delivery times means scarcity of components. Scarcity means pricing power. Pricing power means manufacturers can pass through costs. Passing through costs means higher invoices flow through the chain. Silver sits inside that chain in tiny quantities per unit, but enormous quantities in aggregate. That is the trick. A small amount per unit times a massive number of units becomes a massive amount. People always miss this because they think in objects, not in multiplication. Let us do a simple multiplication that does not require perfect precision to reveal the direction. If a single high reliability switchgear assembly uses only a fraction of an ounce of silver across its contacts and components, it sounds negligible. But if you're building thousands of new substations, thousands of new data halls, millions of new breakers, millions of new connectors, the fractions accumulate. A fraction of an ounce times 10 million units is millions of ounces. Millions of ounces is no longer a rounding error. In a market where 10 million ounces is about 1% of annual supply, a few million ounces is the difference between loose and tight. Now take solar. Solar is already a demand pillar in the 150 to 200 million ounce neighborhood in strong years. If solar installations grow and silver intensity falls, the net can still rise, as we already walked through. The crucial detail is that solar demand is relatively price inelastic in the short run. If policy and economics drive installations, manufacturers will not cancel production because silver rose 10%. They will try to thrift, they will try to optimize, but the build keeps going. Now take electrification. Electric vehicles, grid upgrades, charging networks, industrial automation. The electrification trend is not a single product cycle. It is a rewrite of infrastructure. Infrastructure moves like a freight train. Slow at you first, then unstoppable, and hard to reverse quickly. This is why the silver question is not, will the world want more silver? The world already does. The question is, can the world supply enough without a higher price forcing the system to ration demand? Ration is an ugly word, but markets do it politely. They call it price. Now I want to pull you into a scene because this is where the promise turns into something you can actually use. Imagine a large industrial buyer sitting with a procurement team. They do not care about the meme. They care about continuity. They see that annual supply is around 1 billion ounces and industrial demand is around 600 to 700 million ounces. They see solar is around 150 to 200 million ounces. They see jewelry and silverware and other uses. They see investment demand can swing tens of millions. Then they see deficits in recent years that can be around 100 million ounces or more. They ask one question: if the deficit persists, where does the extra metal come from? That only 3 answers. Inventories draw down, recycling increases, or demand is destroyed. Inventories drawing down is the easy answer until inventories become low. That is the point. Inventories can mask a problem for years. Then the masking ends and the market has to choose between price or shortage. Recycling increasing is real, but it has a ceiling in the short run. You can only recycle what exists and is collected, and even if recycling rises by 20%, if the base is roughly 200 million ounces, A 20% rise is about 40 million ounces. 40 million ounces is meaningful, but if your deficit is 100 million ounces, it does not solve it. It reduces it. Demand destruction is the brutal answer. It means the price has to rise enough that some users stop or substitute. Now watch what happens when you put these three answers into a timeline. In the short run, inventories and premiums carry the load. In the medium run, recycling and thrift carry some load. In the long run, only new mine supply and sustained higher prices can reset the balance. Mines are slow. New mines can take years, not months. That is why silver can stay tight even when everyone agrees it is tight. Agreement does not dig or... This is the core of why people get trapped. They wait for confirmation in price. Price is the last confirmation. The first confirmation is the stubbornness of the balance. If you have a deficit year after year, you are consuming your safety buffer. It is like paying your bills by selling furniture. At first, nothing looks broken. The bills are paid. Then one day you realize the house is empty. You did that. You saved money by not checking the small leaks. You paid anyway when the ceiling finally stained. Now, the prize you came for is this. What signals tell you the system is turning the dials? Here is the clean map expressed as a sequence you can watch without needing a terminal. First, watch physical premiums in the forms that matter to the average buyer. Because retail premiums often move early. When retail premiums rise while spot is flat, it means immediate availability is tightening. It means somebody is paying extra to bypass the paper price. Second, watch inventory drawdowns over time rather than daily noise. If inventories fall for months, that is not a headline. It is a trend. A fall of 5% in a quarter is not random. A fall of 10% over 2 quarters is not random. When the buffer shrinks, the market becomes sensitive. Sensitivity is what creates sharp moves. Third, watch borrowing costs for metal and short-term tightness indicators. If the market starts paying up for immediate metal, that is the canary. It means the bridge between paper and physical is getting crowded. Fourth, watch the behavior of silver relative to gold. This is not mysticism. It is a way to see whether silver is acting like a monetary metal or an industrial metal. When gold rises and silver lags, it suggests fear or monetary demand without the industrial squeeze expressing itself yet. When silver starts to outperform gold in a risk-on environment or in an industrial upswing, it signals the industrial engine is pulling. Now, I am going to give you a simple ratio logic. It is not magic. It is just a meter. If the gold to silver ratio compresses, it means silver is gaining relative strength. If it expands, silver is losing relative strength. The ratio is a reflection of which narrative is dominating. Monetary fear or industrial squeeze. In a world where AI and electrification keep pushing industrial demand, the industrial squeeze can reassert itself even if the macro environment is noisy. Fifth, watch the macro driver that hits all commodities. Real interest rates. When real yields rise, holding non-yield assets becomes more expensive, so commodity prices can get pressure. When real yields fall, the opposite happens. This matters because silver is a hybrid. It feels like a commodity and a monetary hedge. That means it can be hit by higher real yields even if the physical story is tight, and then it can catch up violently when the macro pressure eases. That is where the moves happen, not when everything is easy, when signals diverge and then snap back together. This is where most people lose money. They pick one story and ignore the second story. You cannot do that with silver. It will punish you. So here is how people usually behave. And you have probably seen it. They buy after a spike because they finally feel safe. They sell after a drop because they feel betrayed. They treat volatility like morality. They think the market is judging them. It is not. It is a machine clearing bids and offers. If you want a more durable approach, think in layers. Layer 1 is protection. If you want silver as a hedge, you size it like a hedge, not like a lottery ticket. That means you can hold it through drawdowns without panic. For many people, that is a small single-digit percentage allocation, not because small is weak, but because survival is the only strategy that compounds. Layer 2 is torque. If you want upside exposure, that is where miners and streamers come in, but you size them like volatile equities because they are a 10% move in silver can translate into a much larger move in a miner depending on costs and balance sheet That is why you do not treat them like a savings account. Layer 3 is infrastructure. If you believe the AI electricity build-out is real, you can also position in the electrification winners that benefit from capex regardless of whether silver price moves this week. Companies like Eaton, AB, Schneider Electric, Siemens, and Vertiv live in that flow. Their revenues are connected to order books and build cycles. Their risk is valuation and cycle timing, not whether an ounce of metal goes from 25 to 26 tomorrow. Now let us talk about companies that get hurt, because this is where you look smarter than the average viewer. Higher silver is not only a win for some manufacturers, silver is a cost. If they lack pricing power, their margins compress. If their gross margin is 10% and input costs rise 2% of revenue, they just lost 1/5 of their margin. That is not a small hit. That is an earnings miss. So even in a bullish silver world, you have to separate who can pass costs and who cannot. You can see this in basic margin math. If a company does $100 of revenue and earns $10 of gross profit, they have a 10% gross margin. If input costs rise by $2 and they cannot pass it through, gross profit falls from 10 to 8. That is a 20% drop in gross profit from a 2% revenue cost shock. That is why cost shocks matter. This is why the simplest company filter is pricing power. If a company can raise prices in line with costs, it survives. If it cannot, it bleeds. Now, we still have one more mystery to solve, and it is the one everyone argues about in comments. If the physical market is tight, why does the price sometimes feel dead? Because the market can stay in a regime where the marginal seller is financial and the marginal buyer is industrial, and the financial side can temporarily dominate the tape. Futures flows, dollar strength, real yields, and risk sentiment can cap the price even while the physical side is quietly drawing inventory down. You need to picture two hands on the same rope. One hand is pulling because industry needs metal. The other hand is pulling because macro funds are adjusting exposure. The rope does not move much until one hand loses grip. The day macro stops leaning on the price, the industrial pull is suddenly obvious, and the rope moves fast. That is why your job is not to predict the day. Your job is to recognize the regime. Here is a regime checklist that uses numbers instead of vibes. If annual deficits are in the high tens of millions or more, that is a structural tailwind. If industrial demand is above roughly 60% of total demand, silver is tied to real economy hardware. If solar demand is in the mid hundreds of millions of ounces, it is a pillar, not a fad. If data center electricity growth is running in double-digit percentages compounded over multiple years, grid capex becomes a multi-year theme. If inventories trend down over quarters, not days, the cushion is shrinking. If premiums rise while spot is flat, physical is speaking louder than paper. If silver starts outperforming gold over months, the hybrid is leaning industrial. If real yields stop rising or begin falling, the macro headwind eases. If multiple of these align at the same time, the probability of a larger move increases. Notice I did not promise certainty. I promised a map. A map is what lets you act without gambling. Now let me bring this back to you, because the whole point of this channel is not to worship charts. It is to protect your decision making. You saved attention by treating silver as a niche story. But the world moved on. Silver became a core input to the energy transition and the digital economy. You saved the effort of learning the plumbing. You've paid anyway by being late to the realization that the price you see is not always the price the system pays. The people who do best in this kind of market are not the loudest. They are the calm ones. They build positions when the story is boring and the numbers are improving. They take risk off when the story is euphoric and the numbers stop improving. If you want to be that kind of person, do this simple thing. Decide your intent before you buy anything. Are you hedging currency and policy risk? Are you speculating on a supply squeeze? Or are you investing in the infrastructure bill? Those are three different games. If you play all three without admitting it, you will feel confused because your expectations will conflict. If you are hedging, you care about long-term debasement and reliability. You size smaller and hold longer. If you are speculating, you care about timing and signals. You size smaller and use risk controls because volatility can break you. If you are investing in infrastructure, you care about order books, capex, cycles, margins, and valuation. You can hold through metal noise because the business flow matters more. And if you are doing more than one, separate them in your head because mixing them is how emotions hijack your portfolio. Now I want you to do something right now that costs nothing and improves your future decisions. like the video. So the algorithm actually shows you this kind of content. Again, subscribe because this story is a series, not a single episode, and send it to one friend who is obsessed with AI but never asks what powers it. Because once you see AI as an electricity story, and electricity as a hardware story, and hardware as a materials story, you stop being surprised by what moves and you start being early. So here is the final synthesis, and I want you to feel how simple it becomes. Silver is not rare because the earth ran out. It is tight because the modern world scaled demand faster than supply can adjust. AI does not need silver directly to drive silver. AI drives electricity demand. Electricity demand drives grid capex. Grid capex drives high reliability hardware. High reliability hardware uses silver. Millions of units times small amounts becomes millions of ounces. In a 1 billion ounce market, millions of ounces matter. The market does not need everyone to buy silver. It only needs a small swing in net demand in a market with a small cushion. And the first signal will not be a headline. It will be the boarding numbers, premiums, inventories, borrowing costs, curve shape, relative strength, real yields. That is the map. Now you can decide whether you want exposure through the metal, through miners like Pan American Silver, Hecla, First, Majestic, or streamers like Wheaton Precious Metals, or through the electrification beneficiaries like Eaton, AB, Schneider, Electrit, Siemens, and Vertiv that ride the build-out whether silver is quiet or loud. Different vehicles, different risks, same underlying force. If you want me to build the next episode as a deep dive into the exact physical pressure points, the vault categories, the retail versus wholesale, signals, and the one chart that tends to turn before the crowd notices, subscribe and comment the word silver map, because I read the comments and I build what you actually want to watch. And remember, you do not need to predict the exact day the market wakes up. You just need to stop sleeping through the evidence.